Join us today as we're going to be discussing the 5 levels of IBC, and this is going to help you rise to the level you want to live the life that you want.
Enjoy the episode.
If you're an investor or want to be an investor and you're looking to create passive income that exceeds your monthly expenses, then this is the podcast for you. Here on the Infinite Wealth Podcast, we combine the philosophies of Robert Kiyosaki's Rich Dad Poor Dad along with Nelson Nash's infinite banking concept. Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso, and today we're going to be talking about the 5 levels of the infinite banking concept. And the reason we're going to be sharing this with you guys is so that you guys can advance to the level that you want to live the life that you want. Anthony, when I say that, what does that mean to you?
I tell you what that means to me. I think it'll be helpful for people to know what the levels are. Mm-hmm. And what we're going to talk about, not just what the levels are, but more of what the mindset is.
Yeah.
You know, what the downside of being in this level. And then more importantly, we're going to talk about, well, how do you get to the level you want? So we're going to talk about some tactics that you can do to level up your IBC.
Well said. I would agree. I'd add that, right, oftentimes when people are getting started or maybe they're early in infinite banking, you hear about all these ideas or even strategies that surround it, and some of it's noise and some of it could be applicable to you. So today what we're going to be doing is maybe organizing some of this information for you guys so you have an idea of where you are and maybe you guys can reach to that next step if it works out for you.
All right, Cam, so we got 5 levels.
We do, yeah.
You're going to take the first couple?
Yep.
So tell us about them.
Yeah. When we get started, guys, let me give you an overview real quick. The 5 levels. 1 is going to be a saver. 2 is going to be a banker. 3 is going to be the beginning investor. 4, expert investor. And then 5 is somebody that's all in with infinite banking. And man, let's get started. What do you think?
Let's do it.
Awesome. All right, guys. So here's some characteristics of the saver. This individual is typically somebody that's just getting started with infinite banking. And really a great way to measure somebody's commitment to infinite banking is the amount of premiums they're putting in relative to their income. And so when we're looking at somebody that's in the saver phase, it's usually 3 to 5% of their income. A lot of times I'll tell clients, this is like when someone is not even really 1 foot in, 1 foot out. I usually say they're kind of just dipping their toe in.
Yeah.
Right. They're just like, hey, I've heard about this idea. I'm going to see if this is going to work. I'll try it. So you throw a few $100 at it a month, and that's kind of where you're at. The mindset along the same lines is this is somebody that is pretty skeptical of the infinite banking concept. A lot of the people that are here in the saver phase are a lot of the people that have maybe been following Dave Ramsey for a while, and they've completed all the steps, and they're asking themselves, what's the next, right? What is next for me? And so you get a lot of the people that are coming over that are looking at infinite banking in that phase. There's 2 kind of things that stick out in regards to the mindset. 1 is they view premiums as a payment.
That is very important point there, Cam.
It is. And that's one of the blocks that people have when they get started is, again, we spend a lot of time on mindset. And one of the things we like to remind clients at this phase is that premiums are more like a deposit, right? As we're taking money from one pocket and we're putting it into the next. And so that's what we like to remind them of. And then the other kind of hallmark of this one would be somebody that's afraid of taking loans. When we do annual reviews, one of the things that we go over, one of the many things that we go over is the loans and how are we handling the loans. And if I go in there and I see somebody hasn't taken any loans, more often than not, they're going to be in this kind of saver phase where they're a little bit afraid to access those funds. And so we like to have conversations around that. The way that a saver is typically going to be using the policy at this point is really just an alternative for savings account, checking accounts, maybe a high yield savings account, something like that. They rarely ever use the policy, and really they're just looking at it as a source of tax-free income in retirement. Oftentimes we'll take an intake form, and when we're going through it with somebody, we maybe have, I don't know, I guess maybe 10 or a dozen different options that somebody wants to use the policy for. And if somebody just clicks on that tag where it says tax-free income, right?
That's a saver.
That's a saver, right? They've got some reservations, which helps me kind of figure out kind of where they're at. The other side of this is the downside to kind of being here in this phase is, oops, let me find this. The downside to being in this phase is that they're still investing kind of in the traditional or the
Mm.
typical kind of opportunities that are out there. And they've oftentimes have more cash outside the policy. And so when somebody comes to us with the question is, hey, I want to make this investment or I want to do something, but I've got a whole bunch of cash outside this policy. Again, that typically tells me that they're kind of in this
Mhm.
saver phase where they haven't fully adopted it yet. So the other downside to this is they've got a small death benefit, a permanent death benefit, and then they've got opportunity cost that is working against them. Guys, if you aren't familiar with what opportunity cost is this is the loss of money that you could have had by taking the second best option. Does that make sense?
Mhm.
Okay, awesome. We did a whole video on that. Guys, if you have questions on opportunity cost, feel free to go back and take a look at that. The other thing that I would say here in this part of it is the lifestyle is really somebody that's working a job much longer than they would like to. They're earning less than they'd like to. They're paying more in taxes and they're having less time than they would like to. So, again, I think what sums up this kind of saver position is somebody that's just getting into the infinite banking concept, but really isn't ready to take any action yet.
Well done, Cameron. Well, first, I want to say, whatever level you're at, if you're happy with it, then that's the right level. Not everybody needs to increase the level, and not everybody needs to be all in. And also, I would tell you what, one of my clients, I'd put them in the saver category. However, they are putting in some large premiums, but they were scared. They were scared of the word loan,
Mm-hmm.
and they never wanted to take a loan because they didn't want to pay the interest. And then what had happened when you talk about opportunity cost? I mean, now she's had her policy for over 10 years. The great thing is it's screaming cash.
Yeah.
And now when she puts in $1, I think it's growing by $1.75.
Nice.
She hasn't used the policy yet. I mean, she has over $1 million in cash value. And where the lost opportunity cost is, now we've re-engaged and she's using her policy to buy a home, and now she's looking to buy some commercial property. Now she kind of sees it,
Yeah.
like it clicked. But the lost opportunity cost is, and this is big time for the saver. Remember, when we take a loan, we're not taking it from your cash value, we're taking it from the insurance company. So we take a loan to buy an asset and pay it back. Let's say you pay back in 10 years, you're going to be in the same spot, whether you took a loan or not. So that's a huge opportunity cost. And I did let her know this, just I didn't mean to rub it in, but she could, how many homes she could have bought
Mm-hmm.
over the last couple of years and use that rental income to pay it off. But again, we got to start somewhere. And to be honest, I started in it as a saver. Like you mentioned, putting your toe in the water. To me, this sounded way too good to be true.
Yeah.
Right? Nobody I knew was doing it, so I tried it. And then as I felt more comfortable, then I started building up to the higher level, which the higher level is the banker.
Mm-hmm.
So Cam, tell us about that level. Imagine if you could grow your wealth, access your money anytime tax-free, and never break the compound interest curve while you use your own money. Well, that's exactly what the infinite banking concept does.
And we help investors just like you implement this strategy, and we'd love to show you how. Schedule a free call with us and start taking control of your financial future today.
The link to schedule that will be in the show notes.
Yeah, the banker's a fun level, right? This is when somebody's kind of taking that next step. There's a little more kind of buy-in on the strategy, and you'll see that through the amount of premiums that they're contributing. Usually it's going to be somewhere between maybe 5 to 10% of their income. And what you'll see here too is they're starting to redirect some of the savings that they were putting into alternate or different accounts. So maybe some additional 401k funds that they're redirecting back over to the policy, or maybe even a car payment, right? As they know they need to start saving for the next car. And so that's a quick, easy example for them to grab onto. And so that's what they'll start doing. The mindset of somebody here is a little bit more intentional. So in that saver phase is they come in and they're like, you know what? I'm going to put some money in here. I don't really have a plan. In this banker phase, they know exactly what they want to do. And typically that plan is going to revolve around liabilities. So they're going to be looking to recapture, car payment, like I just mentioned. They're going to be looking to maybe pay off some debt or take over some vacations, right? The financing of those. Um, Couple of examples here is this is often when somebody first gets done reading Nelson's book,
Yeah.
right? So
Mm-hmm.
somebody just read the book, they're on fire, they've paid, interest on car loans, for a majority of their life, and then they're thinking, man, I would love to recapture this. So that's kind of where somebody's at. I'd say we get quite a few people that are there. Another example that I recently just had is a gentleman had called in, and it was in our first conversation. He was ready to get started. The reason he was ready to get started is because he read Nelson's book, realized he had two loans
Mm-hmm.
that were outstanding, one at 13% and one
Mm-hmm.
at 15%. And he said, hey, I realized halfway through the book, if I could set up a policy to retake or take over that financing, he's like, I'm going to be just fine over the next 10 to 15 years. And so that would be a great example of somebody that is kind of here in this banker phase. They don't have a lot of trust in Wall Street,
Mm-hmm.
and they've got a kind of mistrust for banks. And so, man, infinite banking really speaks to them. Some of the downsides that you'll see kind of here is that, Anthony, you mentioned opportunity cost, but the point I would make here is this one. When you get to a point where you're a banker and you start to finance vehicles, one of the biggest downsides that I'll always caution clients on is that when you do that, you take a loan, you go buy the vehicle, the responsibility or the burden of repaying that loan is going to fall on you, the client,
Mm-hmm.
right? And so you're the one that's got to go to work every single month, go earn that paycheck, and go send that money back to the policy to replenish that loan. And if that's the plan, that's fine. But my honest opinion is that's not the best thing that we could be doing with that policy. And so, uh, what I would tell you is kind of attacking cars or approaching it that way is a great way to get started. But again, it's not the best thing that we could be doing with those dollars.
Agreed.
Lifestyle. This is where somebody, right, is kind of maximizing tax-free accounts. They, along or similar to us, believe that taxes are only going up. And so what they're trying to do is they're trying to minimize their tax liability moving forward. And so they're maxing out these types of accounts. The stress level that you start to see in somebody when they do move from a saver to a banker is it's much lower, right? They're not tied to the market. They're
Mm-hmm.
not subject to the volatility of the market. And to be honest, you'll see their excitement start to rise too, right? And so as they start to take over a little bit of control, as they do have a little bit of excitement that comes along with that. The other note that we have down here is the kids will be very excited because mom and dad are going to have some permanent death benefit in place. And so we thought we'd make note of that as well.
I think I started off as a banker because my first loan was to pay off my car loan.
Yeah.
But when you talk about the less stress, I remember one time my wife and I were on vacation, and this is when like Europe was in turmoil and there were riots in the streets of Greece
Mm-hmm.
because they were spending more money than they were making, and they had to make a lot of cuts. People were just highly upset with it, and I'm watching the news, and I'm seeing the stock market just going down, 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 and down. And I tell my wife to hurry up and get ready,
Yeah.
so we can go on and leave because I didn't want to see this. But then I realized, you know what? That's not affecting me.
Yeah.
Right. If anything, when that market goes down, I have that's when I want to go in and buy. But you talk about the stress level. If I had a lot of my wealth subject to the stock market, and I'm on vacation and that stock market is crashing, this would be very difficult to enjoy the time.
Yeah.
So I think that stress was a very good point, Cam.
Man, I'll share this quickly. This is back in 2008, late 8, early 9s, when the stock market was crashing. And I was at a golf course in Las Vegas, and I remember walking out of the clubhouse for my tee time. And there was, I kid you not, there was probably 60, 50 guys that were all standing around this TV screen, staring up at it, just watching the stock market, right, just drop. And I'm thinking, this is the weirdest thing I've ever seen, right? Because people go to a golf course just go and relax, and these guys were glued to the TV just watching this. It was like watching a car accident. I'll never forget that. But yeah, it was eerie. But anyways, all right, Fasto. Man, what's next up? What's after banker?
The next one we call the beginning investor. And honestly, I think this is probably where I know we're going to talk about this at the end, but I think this is where a bulk of our clients are, or maybe they want to become an investor. And what they view on their premiums, we're probably going to be somewhere between 10 and 20% of the income, but their mindset starts changing.
Mm.
They're not viewing their premiums as a payment. They're viewing it as a deposit, which is a huge step if you want to level up with IBC. Because if you view your premium as a payment, we want to stop payments as soon as we can. But when do we want to start deposits? Hopefully never. Right.
Yeah.
So that piece is great. In addition, they start looking at changing their view on financial success. They're more focused, more of the Robert Kiyosaki model, where we have passive income to be more than our monthly expenses. And at this point, they probably don't have much or any. But the key thing is they are working to achieve that. And how they're going to use their policy is going to be very different than the others, because they're going to be typically using it for assets, right? And that asset could be for rental properties, investments, or business. But the bottom line is we're using the loans to buy assets. And what is key is the asset is repaying the loan. On the prior two examples, well, really the first one is scared to use a loan,
Yeah.
right? But the banker, one downside of the banker is the one repaying the loan. When we're becoming an investor, we have the assets repaying the loan. Now I tell you that some of the downsides of this are, you're gonna lose some old friends.
Why do you say that?
What I say that is because you're gonna want to, with typically a lot of your friends are probably doing the 401k or the traditional stuff.
Mm-hmm.
But then when you go and approach them and say, hey, I just got a whole life policy and I'm taking a loan against it and blah, blah, they're going to think you're crazy.
Yeah.
Right. We shouldn't be buying. Real estate is risky. Owning a business is risky. But if you want to level up, you need to hang around people that are like-minded. So some of those people are going to be doomsdayers, and they're going to be bringing you down. And when you have a bad investment or a rental property, odds are they're going to be the first one to say, man, I told you so.
Yeah. Yeah.
Did you see how much the stock market went up today? Also, probably the biggest downside here is we got to grind, right? Because typically we have our 9 to 5, but really, so that means we need our time from 9 to 5. After we're working, that's the opportunity we have to grind, to be able to get to the next level and take this additional action and education. Now, some of the lifestyle differences, we're now in this level, we're starting to take control of our income, our taxes, and I think the most important asset we have is our time. Now, on the next level, this is an experience.
Don't mind me jumping in real quick.
Yeah.
Yeah. I was going to share a point. I'll let you catch your breath. Is that you alluded to it, but in these first two steps, I would say this is all about becoming your own banker, right? And Nelson Nash's book, right? So you could read this book and you could get through these first two phases, no problem.
Mm-hmm.
But really what Anthony is describing here in this beginning investor and then from these next two options is really incorporating Robert Kiyosaki's mindset approach and then bringing in opportunities to invest and create income. And so that's why our approach has always been, hey, I think if we can combine these two, this is the best case scenario for everybody. And so you'll start to see that transition here in these three options.
Cam, that's a very good point. And on that note, I want to let our podcast team to cut out that compliment that I gave Cameron. Okay. Anything else, Cam?
Nope.
Okay. So the next one, this starts getting even more fun. This is more an experience investor. Now with their premiums is typically going to be all of their free cash flow, right? They need to put it somewhere. Instead of storing it in a bank, they're going to be storing it in the policy. Now with their mindset, They're looking to expand their passive income, and they probably have left their job and they don't have a 401k. Cam, you know what they have? A 401f.
401f.
A 401, who the F cares? I don't need a 401k, right? They have control of their money and they're putting it to work for themselves, not for Wall Street.
Nice. I didn't see that one coming. I didn't know.
I know you saw that on there, and I wasn't going to tell you until the show. But as far as the uses of their policies, all of their investing, they are running it through their policies. They're treating their policy like a rewards credit card for their investments. All the free cash flow goes in the policy. And then when they have an investment, they take a policy loan and deploy and buy that investment, which creates more free cash flow, which means more money will go into the policies. Also, they typically have multiple policies on themselves, because a lot of times we kind of start maybe as a banker or beginning investor, and as we get more comfortable with infinite banking and as our income grows, we should outgrow our initial policy. They're also going to have policies on others. And so we'd first start with family members to make sure that the family is insured, but there's also an opportunity to put policies on key people in your financial life, whether that's key employees or key business partners. Again, we're just expanding our banking system. Now, when you do some serious legacy planning, because for one, we got to avoid the estate tax, but again, that number is pretty high right now. So, but that's going to be readjusted probably in this year. But outside of the estate tax, if you're in this phase, you're going to have more death benefit than you ever imagined. And so that legacy planning needs to be not just the dollars, but more of the sense, as in financial sense, to that next generation. If we want to give it to our kids, we need to make sure that they know how to understand it. Or maybe this is an opportunity. We don't have to give all of our money to our kids. I will tell you, I'm not. And my kids do know that, but they're going to get more money than they need. But our goal is to do some good with some of this death benefit. Now, one of the cons on here is this does take some self-discipline, particularly when you achieve your financial goals and you're grinding. It could be very easy to maybe take a little reprieve. Now you work because you want to, not because you have to. But it's possible maybe that effort to work really is not really there. But we do encourage you, even if you hit that financial freedom number, you have experience that it's healthy for you mentally and physically to share, whether it's coaching others or even doing some volunteer work. Now, as far as the lifestyle here, they have taken control of their income and their taxes and their time. And one thing that's interesting in this category, inflation is their friend.
What do you mean by that?
What I mean by that is a few fold. For one, inflation is going to rise the value of assets. If the buying power of a dollar gets weaker, that means you need more dollars to buy that same asset. So, for example, let's just talk about real estate. Historically, real estate has increased more than inflation. And also, if it's rental income, your rental income is going to go up with inflation. And so if you buy that with a 30-year fixed, or you bought it in cash, your expenses for the most part are fixed. But as inflation comes, your rent will increase, which is just going to increase the bottom line. And also a key thing is when you're at this level and there's money available, you typically have the ability to get it first and for a lower rate. So you can deploy that money to work sooner with a lower cost than the average people.
Well said.
Now, all in. Now, this one is where your premiums equal income. So so when you receive money, instead of it going, it may need to go through a bank, to be honest, but we're not going to store it at a bank. We're going to be storing that in our policy. And some of the mindset, these people are self-reliant. They still don't trust Wall Street because they've proven that they've able to build wealth on their own. And I would say this is a good opportunity for a self-directed IRA. Now, I know we bash 401ks and IRAs all the time, and in part because we feel that they're overused. But there is a place for it, particularly as we're building as we're building that income. As you're trying to build that income, we need to get our money right. We need to have access to it. So a lot of times in this phase, we don't have any of these 401ks or IRAs because we need to use that money now to create income. But once we achieve that level, and we may be in the highest tax bracket, there can be a self-directed IRA can be a great tool. And in case you didn't know, you can have a IRA or 401k rolled into what's called self-directed IRA, which allows you to self-direct where that money goes. So what I recommend using a self-directed IRA for would be on assets that are at taxed at the highest level. So real estate, one of the reasons why we like it is because of the advantages in taxes. So I would never put real estate in there. But if you're doing private lending, or maybe you're flipping land, or you're doing something that's taxed at the ordinary rate, there could be some advantages of putting it in a self-directed IRA. Now, as far as uses, they're going to be using the policy for all the above. Right. And typically at this point, one advantage when we have multiple policies, we can give each policy a specific job.
Mm-hmm.
Like I have a policy that is how I pay for my taxes. I have a couple of policies that I use only for personal. And then the bulk of my policies I am using for investing. And then I also have a separate policy that is my reserve fund. So I'm a big proponent of having 6 months or ideally a year in reserves. Best place to store that, I think, by far is inside a policy. So we can have a policy here that allows us to do other jobs. Now, some of the downsides or cons of this level is it's complex, right? And this is going to take effort and time for you to learn these skills and to achieve this number. And I would say that this is not for everyone,
Mm-hmm.
right? But for the ones that do get here, they lead a pretty enjoyable life. And one big difference here in regards to level of fear, just like Cameron, how you started, where we had the scarcity mindset.
Mm-hmm.
Well, really, that scarcity mindset goes all the way to an abundant mindset when we're all in. And I think it's pretty much accordingly wherever you are in the middle.
Well said, Anthony. Well said. Good overview on those last three options. What I would say, I'll let you catch your breath here, as I start to look at these 5 kind of levels of infinite banking, I start to think about where most of our clients are.
Mm-hmm.
And Anthony, love to hear your input on this after I go, but I would say that
I can go first.
No, I don't. You know, I'm tired of you talking. So are our listeners. I would say most of our clients come to us at that beginning investor phase. Right. I kind of mentioned it early on. They're kind of past the Dave Ramsey approach. They know that doesn't really work for them, and they're kind of past that. They're looking to create passive income, and that's really the main motivator. And so a lot of our clients are in that beginning investor phase, and that's really where our sweet spot is, I would say.
Yeah, I would agree, Cam. I think most of our clients are at the beginning investor. Some are at the banker, and we have plenty that are more of the experienced investors as well.
Nice. All right. So Anthony and I are in agreement that most of our clients that are at the beginning investor phase. Anthony, where do you think most people want to be?
I think where they want to be is the experienced investor.
Why do you say that?
Well, because it goes back to what we talked about it as a lifestyle.
Yeah.
They have control of their taxes, their workload, and more importantly, they have control of their time.
Yep.
What would you say, Cam?
I would say the same thing. I'd say most people want to control was the exact word that I had, is that most people want to take control of that. Most of the clients that come to us are in that beginner investor phase, and they are in that kind of grinding position where they've got a W-2, but maybe they've started down the road of acquiring some real estate or building a business. And so they're making that transition. And so that experienced investor is kind of that next step for most of them.
What I will say is what every level has its place.
Yeah.
Right. And not everybody needs to be an experienced investor. Maybe I spoke with somebody who she really loves her job, but she wants to lead a fulfilling life in retirement, and if something ever changes, she wants to be able to be able to leave.
Yeah.
So she's going to be probably that beginning investor for quite a while, but she's going to be happy.
Yep.
And you know what? If you might be very happy becoming your own banker.
Yeah.
Like, we're not all about having to create all this wealth. We really need to focus on whatever makes us happy. And it doesn't, and money is only a tool.
Yeah. One of the interviews that came to my mind was our interview with Michael Zuber, One Rental at a Time.
Yeah.
I enjoyed that interview. He had a ton of information for us, but the way that he approached W-2 income was contradictory to what most people out there are doing, right? A lot of people out there just bad mouthing and bashing having a W-2 income and your earned income. But man, what he says is, it's a blessing, right? Banks love W-2 income and use that to your advantage. And so kind of in that beginner investor phase, moving over to the experiences, man, you got a great tool. If you've got out there and you got a really solid income, man, use that to your advantage. Don't look at that as a negative in any way. And so that's a lesson that I took away from our interview with him. Anthony, I got a question for you. How does one get comfortable enough to kind of make that jump from going, from a beginner investor, experienced investor to all in, if that's something they want to do, and should they be striving to do that?
I will say one key ingredient is going to be the right coach. Because to me, I think there's kind of division between the five, not picking on you, but the first two that you did, and there's a division between the other three. And the big difference is the use of the policy. First two aren't using it, or are using it for liabilities. The last three are using it for assets. So if your goal is to be your own banker and take over all of those, your mortgage and all those car loans, you need to find the right coach for that. And we can help you with that, but I will say that's not our niche. What our niche is more of working for people who want to level up and want to use it for assets. So if you have a coach who's great at getting you out of debt, financing your cars, they may not be great to help guide you to being able to level up. I'd also say, if you want to level up, the key, you have to want it, because it's going to take effort. And if you want a different result, you're going to have to do something different. And so you need to be open to new ideas and to being uncomfortable. Anything you want to say about like the mindset there?
Yeah, I was going to add, you made two good points, but I'm going to add that you got to be in community. Right. This is not something that you could do on your own. Moving from beginning investor to experienced, or even to all in, is again, the mindset is critical. And so you've got to surround yourself with like-minded people that are kind of pushing you to level up and to take that step when it does get uncomfortable. And so you've got to be in community. And with that said, guys, we do have our online community up and going. And if you guys haven't joined yet, please feel free to jump in there. We got great dialogue, great discussions that are happening every week. And so we're in there motivating and sharing different ideas on how to take your next steps in infinite banking.
Well done, Cam. And that's open to everyone. You do not have to be a client of Infinite Banking to share your story in our community.
Yeah. Faso, any closing thoughts? What do you got?
Oh, this ain't closing. I got some more meat.
Oh, okay.
Here,
wow.
Right.
All right.
Because really what I think the real crutch here of value of this podcast is how can we get to the next level? Right. And I think it's going to take education and action. Now, that education can start with podcasts and start learning what is a business or investment that is suitable for you. Now, I'll make a little teaser announcement. We're working on some resources to help you determine that more scientifically. That will probably go live in the third quarter. Okay. But so we will keep in the loop on that. But in the meantime, a great resource can be podcasts. And there's other podcasts out there as well. But if we've talked about flipping land, flipping homes, flipping websites, creative financing, laundromats, long-term rentals, midterm rentals, short-term rentals. So find a podcast and start. We're not expert in those fields, right? But you need to go talk to one and start doing your education as simultaneously while you're doing that. You need to get your money right, because in order to execute this, it's possible to do with little to no money. But if you have some money, it's gonna help you get there a lot faster. So that's where you need to evaluate of getting your money in order. And one thing we're going to talk about in a podcast coming soon is, can infinite banking replace your 401k? And one example of that will be is you need to put your money so you can execute your goals. If your goal is to create passive income, you need your money in an account in a position that you can use it. If it's tied up in an IRA or 401k, it is locked up and you cannot use that passive income. And Cameron, I'm going to say infinite banking is like a protein shake for your workouts. Right? If you want to get in shape, you want to build muscle, you need to exercise. You need to lift weights. But if you incorporate some sound nutrition, say with a protein shake, that's going to help you achieve your goals faster and with more certainty. And if you want to create more passive income, well, you're going to need to buy some businesses and or investments. But if you give your money the proper nutrition, like with infinite banking, that's going to help you achieve those goals faster and with more certainty. So while you're getting the education, get your money right, and then you'll be in a position to execute. But the key thing is you have to take action. Right? You can read all the books and all the podcasts you want, but if you're just sitting there on the sidelines, you're never going to live the life that you want. There we go.
Well said. Well said. Anything else?
No, that was good.
That was it. Awesome.
Oh, I thought it was good, but
yeah, it was great. It was great. Awesome, guys. Well, we hope that this helps you recognize or identify kind of what phase you're in. And if you want to move forward, right, hopefully this overview will help you do that. Again, it's not that you have to, but we thought that organizing this would be a benefit for you guys. So again, hope you guys enjoy the 5 levels of infinite banking.
Go make it a fantastic day.
Take care.
If you like this video, I know you're like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.